The broader macro market is looking dangerously weak right now. I mean, we are seeing a massive defensive rotation across the board as institutional money essentially flees risk and desperately seeks shelter. But then, right after the closing bell on June 17, 2026, Smith & Wesson Brands, ticker symbol SWBI, absolutely shatters the tape. They surged double digits after hours, completely defying the broader market gravity. Welcome to the Iron Financial Explainer, where we help you forge a stronger portfolio and cut straight through the market weakness with unvarnished hard data. I'm your lead analyst, and I literally read 10Ks for fun so you don't have to.
And I am the Market Skeptic. I am here to ask the hard, uncomfortable questions that you are all thinking at home. Because frankly, when I see a sporting goods stock spike like this in what is objectively a significantly tightening economy, my alarm bells start ringing loud. We really have to ask, is this an ironclad breakout? Or is it just cyclical noise waiting to trap retail investors at the top?
And that is exactly what we are going to hammer through today. We're doing a deep dive into Smith & Wesson's explosive Q4 and full fiscal 2026 earnings report. Get ready for some raw, unhyped financial analysis. Let's fire this up.
So let's talk about this defensive rotation. We are currently watching luxury retailers actively slash their forward guidance. We're seeing massive corporate layoffs hitting the wire every week, and everyday consumers are literally maxing out their credit cards just to buy groceries. People are supposed to be buying significantly less discretionary stuff right now, right? That's the macro consensus. Yet, SWBI puts up a quarter that makes it look like we are right in the middle of a massive economic bull run. I just have to ask, is this a genuine breakout built on a structurally solid foundation, or are they just catching some temporary, maybe politically driven tailwind? Because if it's a temporary breeze, that is going to recoil hard on anyone buying at these elevated post-earnings levels.
It is a very fair question, but to truly answer it, we have to do some heavy lifting. We have to look at the raw metallurgy of their balance sheet and their income statement. The fundamental difference between a temporary momentum trap and a structural multi-year breakout lies strictly in the operational data. Smith & Wesson didn't just casually beat Wall Street analyst estimates. They absolutely obliterated them. Analysts were expecting 23 cents per share. SWBI delivered 36 cents. That is a massive 56% beat. You do not fake a 56% beat with just a temporary tailwind. Let's really drill down into the revenue curve that powered that outperformance.
We need to look closely at this contrast between the final quarter and the entire fiscal year. For the full fiscal year 2026, Smith & Wesson brought in $523.8 million in net sales. That represents a respectable, solid 10.4% year-over-year growth. In this economy, you take that all day. But the final quarter is where the real story lives. Q4 net sales absolutely accelerated, hitting an incredible $178.4 million. That is a blistering 26.7% spike over the comparable quarter last year. Market Skeptic? Okay, hold up. A 10.4% growth rate for the entire year, but then they suddenly rip a 26.7% growth rate in just the final 3 months? That's exactly what I'm talking about. Why the sudden, intense heat in the forge at the very end of the fiscal year? Are they heavily discounting their inventory to artificially clear out warehouses and juice their numbers for the earnings call? Or did consumer demand genuinely spike that hard out of nowhere? You simply do not jump from a 10% annual growth trend to a nearly 27% quarterly growth spike without a very specific, aggressive catalyst.
Well, I can tell you right now, it absolutely wasn't discounting. In fact, it was the exact opposite. They actually deliberately reduced their promotional activity during this period. To understand this aggressive final quarter acceleration, we have to look closely at how they are executing out in the broader market against their peers.
Lead Analyst. If you listen to CEO Mark Smith, he attributed this intense Q4 heat directly to the enduring power of the iconic Smith & Wesson brand and the relentless market share dominance. When their competitors were actively struggling with supply chain bottlenecks or dealing with fading brand loyalty, Smith & Wesson leveraged their legacy reputation. They didn't just passively float on a rising tide here. They aggressively seized shelf space. They captured consumer mindshare. They were actively taking market share away from their rivals in a broader firearms market that was actually somewhat flat overall. Market Skeptic. Okay, brand power is a fantastic, sexy buzzword for an earnings press release. I hear it all the time. But brand execution doesn't actually pay the utility bills on its own, does it? I want to look under the hood at the actual margin machine. If they are growing market share that aggressively in a flat market, are they secretly sacrificing their profitability behind the scenes to do it? Let's check the margins. They aren't sacrificing a single thing. Let's hammer home these margins, because this is where the story gets really compelling. Q4 gross margin actually popped 100 basis points to land at a stellar 29.8%. And for the full fiscal year, they held a very solid 26.9% margin. Wait, a 29.8% gross margin for a heavy manufacturing company in this punishing macro environment where raw materials and labor are through the roof? How is that mechanically possible? It all comes down to volume-driven fixed cost absorption. Think about it like a giant factory floor. The cost to keep those massive factory lights on, the furnaces burning, and the CNC machines running is relatively fixed, regardless of how much you are actually producing. So when you pump 23% more units through that exact same factory footprint to meet surging demand, the overhead cost assigned to each individual firearm absolutely plummets. The more metal they forge, the cheaper each unit gets at the gross level. This brilliant absorption effect was the primary driver of that 100 basis point expansion. It cleanly offset a lot of the external macro noise.
But it is not just about making more units efficiently. It is about having ironclad pricing power. Quarter over quarter, handgun average selling prices, or ASPs, rose 4.3%. Long gun ASPs climbed 4.5%. And here's the kicker. They pushed through a 2 to 3% baseline price increase back in January that went completely unnoticed by the consumer. No fanfare, no media backlash, and most importantly, no volume drop-off.
Market Skeptic, I have to admit, that is basically the holy grail of retail. Charging people more money for the exact same product and having them essentially thank you for the privilege by buying more of it. Pushing a quiet price hike without triggering a massive demand recoil is undeniably impressive. But I'm going to keep looking for the structural cracks in the armor. It cannot be all perfect. What about the headwinds? What is eating into that cash?
You're right to ask. It definitely wasn't a free ride. CFO Deanna McPherson explicitly noted that this margin growth was partially offset by increased volume-related spending. They also face massive freight costs and ongoing tariff headwinds. But the raw structural strength of their pricing and that factory absorption simply outpaced those cracks.
All right, let's get into the core data that is really keeping me up at night, because this massive divergence here is glaring. Handgun shipments into the sporting goods channel leaped by an incredible 23.2% year over year. But if we look at the NICS background checks, which, as we know, is our absolute best proxy for actual consumer purchases at the retail counter, they only rose a meager 1.1%. And on the long gun side, shipments were up 28.7%, while NICS was only up 3.5%.
I know exactly where you are going with this.
Oh, absolutely. I am crying channel stuffing. This is a classic, devastating cyclical trap in this specific industry. A manufacturer ships an absolute mountain of inventory to their distributors just to make their quarterly earnings numbers look spectacular. But the end consumer isn't actually buying them at that same elevated rate. This divergence warns of bloated retail shelves. And you know what bloated shelves mean: heavy discounting next quarter, collapsing margins, and a rapidly recoiling stock price. Are we just looking at an accounting illusion here?
I anticipated that exact argument, which is exactly why we meticulously run the inventory stress test. I'm going to forcefully counter the channel stuffing narrative right here, right now. Just look at the channel inventory data. Despite those surging 23% shipments into the distributor network, retail inventory out in the field remained completely flat relative to Q3 and last year.
Market Skeptic? Completely flat? With a 23% shipment surge and only a 1% NICS increase? How does the actual math work there? That doesn't add up.
It adds up when you understand the limitations of the NICS data. NICS checks do not perfectly capture multiple firearms purchased on a single check. They also don't account for concealed carry permit exemptions in over 20 states. NICS is a proxy, not a perfect one-to-one metric. The fact that channel inventory remained flat definitively proves the sell-through at the retail counter was exceptionally healthy. The foundation is solid. Furthermore, Smith & Wesson aggressively slashed their own internal inventory by a massive $33.6 million, taking it down to a very clean $156 million. They are not stuffing channels, they are efficiently, relentlessly moving metal.
Okay, I will concede the inventory actually looks surprisingly clean. You made your point. But what is the actual tangible catalyst driving this specific sell-through? Why are consumers walking into a gun store right now in this economy and specifically choosing Smith & Wesson over the intense competition from Glock, Sig Sauer, or Ruger? I can answer that with one single staggering metric. 38%. Just let that sink in. 38% of their total shipments for both the fourth quarter and the entire full fiscal year were driven entirely by their new product engine. This is their innovation arsenal doing the heavy lifting. They didn't just lean on selling their legacy models. On the highly competitive concealed carry side, the Bodyguard 2.0 and the Shield Carry Comp have absolutely dominated the conversation. They completely refreshed that segment. They also rounded out the premium semi-auto pistol line with the M&P HD Steel and the Competitor.
Market Skeptic. I actually saw the Model 1854 heavily featured on the earnings call transcript too. That caught my eye.
Exactly. The Model 1854 lever-action rifle. That was a brilliant, highly strategic entry into the traditional hunting white space where Smith & Wesson historically hasn't really competed. Entering that space diversifies them away from relying solely on the highly cyclical, politically driven concealed carry market. Along with the folding FPC carbine, they are actively capturing entirely new demographics.
I'll acknowledge the operational strength and the sheer power of the product engine. It is clearly working on the revenue side. But a company is really only as strong as its balance sheet. If they are pouring this much capital into R&D, tooling for new products, and physical expansion, are we staring down a hidden debt bomb in what is currently a very high interest rate environment? Let's pivot to the balance sheet risks.
Let me stop you right there. There is absolutely zero debt bomb here. They spent fiscal 2026 aggressively reloading their cash flow and de-risking the entire balance sheet. First, they generated a massive $114 million in pure operating cash flow. Second, they took that cash and aggressively deleveraged, paying off $60 million on their revolving credit facility. Finally, they ended the year with an ironclad foundation of only $20 million in total debt, mapped against $28 million in cash. They are literally in a net positive cash position. Wow. Okay, a net positive cash position of $8.2 million is a massive anomaly in today's punishing, high-interest rate manufacturing environment. I'll give them that. It undeniably gives them the structural flexibility to survive a severe cyclical downturn. But having that cash flexibility means absolutely nothing if management misallocates their capital, which brings us to the massive elephant in the room: capital expenditures, CapEx.
I critically need to challenge this specific decision. Management just announced they are dumping an additional $20 million in CapEx into the legacy Springfield facility in FY 2027. Think about this. They just spent an absolute fortune moving to a massive, shiny new headquarters in Tennessee specifically to escape high taxes and uncooperative state governments. And now they are dumping $20 million right back into the legacy Massachusetts plant for 20 new CNC machines. Make it make sense. Is this incredibly poor planning? Did they underbuild the Tennessee facility?
I fully understand the intense skepticism on this, but CEO Mark Smith defended this perfectly on the call. He called Springfield their machining center of excellence. Their entire business model relies on flexible manufacturing, precisely balancing internal forging and machining with external suppliers. Right now, they foresee sustained long-term structural demand for these new product lines we just talked about. By adding these 20 CNC machines, half of which will be operational by this summer, the rest by the end of the year, they are actively insourcing their capacity. They are reducing external supplier bottlenecks and locking in significantly higher future gross margins. It is a high-return strategic investment, not a backtrack on their relocation strategy.
Now, let's synthesize CFO Deanna McPherson's forward guidance for fiscal 2027. She projects confident mid-single-digit revenue growth for the full year. That is built firmly on a highly bullish expectation for Q1 specifically, where she is projecting a massive 15 to 20% year-over-year revenue spike.
Hold on, analyst. You're giving everyone the bullish headlines, but I'm looking closely at the fine print here. She also explicitly warned of a sequential 5% decline in average selling prices in Q1. A 5% ASP drop is a major red flag for those precious 30% margins you were just hyping up. And even worse, she warned their effective tax rate is going to jump significantly, hitting roughly 30%. That is a punishing tax rate that will absolutely drag down net income, even if top-line revenue hits that 20% spike. Context is everything. The 5% ASP decline is entirely product mix driven. Handgun volume is shifting, but the long gun mix is offsetting it partially. It is not a structural loss of pricing power, it's just what specific products consumers happen to be buying this quarter. And yes, the 30% tax rate is heavy, but it is just a normalization. They are rolling off of prior favorable tax adjustments and massive relocation write-offs connected to the Tennessee move. It is an accounting normalization, not an operational failure.
Fine. I see the accounting logic. But I have some final macro concerns before we give our definitive verdict on this stock. We are constantly looking at potential cyclical shifts. What happens if consumer credit truly maxes out and this discretionary spending recoils mid-CapEx cycle? That leaves them with 20 brand new CNC machines spinning in Springfield and zero retail demand. Furthermore, let's talk about generative AI as a legal risk. Think about IP scraping, aggressive automated marketing compliance violations, or AI-generated misinformation, dragging this brand into complex, headline-making courtroom battles. And ESG? Continued environmental, social, and governance pressures severely limit institutional investment capital from ever touching this stock. There are external legal and cyclical hazards that these pristine financial numbers alone simply do not capture. Those are all incredibly valid points. The broader environment is always fraught with heavy regulatory and cyclical risk. That is the inherent nature of this specific sector. It's unavoidable. The ultimate question is whether Smith & Wesson has the structural, financial integrity to withstand it.
So here is our final verdict. We've meticulously synthesized the entire data dump. Is Smith & Wesson built on an iron foundation, or is it a dangerous cyclical value trap? From my analytical perspective, the operational execution right now is absolutely pristine. A 38% revenue mix purely from new products, a totally deleveraged balance sheet with only $20 million in debt, and flawless fixed cost absorption resulting in near 30% gross margins. If you're a long-term investor, you can confidently hold through the inevitable cyclical noise because that fortress balance sheet and net positive cash position vigorously protect your downside. The trading thesis here is incredibly strong fundamental value.
All right, I'll balance out that aggressive bullishness. For short-term momentum traders, you need to be careful. The after-hours surge is already pricing in a massive amount of that Q1 perfection. The 30% normalized tax rate and the 5% ASP decline mean the margin of error for the next earnings call is razor thin. If you are actively trading the momentum, take your profits now and set your trailing stop losses strictly ahead of the Q1 earnings call to protect that after-hours premium. But I will fully concede to the analyst on this. The internal inventory slash and the aggressive debt payoff definitively prove this isn't some fragile house of cards. It's a real, structurally sound machine.
And that leaves us with one final, deeply provocative question. How much intense heat can this forge actually handle before the next macro cycle inevitably turns? They clearly have the market share momentum and the margin machine perfectly dialed in today, but you can be sure we will be intensely tracking their Q1 execution to see if they can genuinely maintain this blistering pace. Thank you for tuning into this Iron Financial Explainer, and we will see you on the next deep dive.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.